In going back to the question, is the Dow a good metric? I don't use it very much anymore, partly because it's 30 companies.
This is coming from the guy who still quotes points, just so you know.
Right.
He says hey, the S&P's up 30 points.
Okay. You know what? We're getting personal now. I'm about to walk off the podcast.
Welcome to the Market Moment. This is Matt Walters, and I'm here with Lee Mackey and John Martfeld. How are you guys today?
Doing great.
Good.
Awesome. Today we're going to talk about the stock market, where it's at, what's been going on, whether the Dow Jones Industrial Average is outdated, and how a teenager got into investing. So some good topics for today. So just to jump in, before we get started, want to, I guess, kind of ask you guys, if you like the content, if you like what we're doing, go out, like, subscribe. Our subscribership and viewership has been growing at a pretty good rate over the last few months, which is awesome. So go out and give us a like, a subscribe, keep up with what we've got going on. We promise we will keep trying to make these better and better. I assure you, we know there's plenty of room for growth, but we're working on it. We've got some really good guests coming up. J.P. Morgan, economist, coming up here in the coming weeks, which will be really cool. So we're trying to get some more guests involved and just having fun with it. So anything you guys want to add?
No, not at all. When he said you guys, I thought he was asking us if we liked the content.
I know.
And I was like, I don't know.
I love the content.
Do you?
You're asking me, yeah.
Neither of you heard my
Yeah.
Sorry.
It's good to see John back.
It is.
Yeah. I was in Florida.
Yeah.
And it wasn't sunny. It was warmer here than in Florida.
Isn't that crazy?
Which is frustrating.
That is frustrating.
In February, you
Yeah.
go down there and have to wear coats. People down there are wearing like fur coats.
Yeah.
Because it was like 50. And to them, that's like 10.
Mm-hmm.
So it wasn't that bad, but, could have used a little more sunshine.
Yeah.
In the Sunshine State.
But pretty
hey,
warm.
Today's like 83 here.
I know. Here, this is crazy. It's going to be 40-something tomorrow, right? High of 45 tomorrow.
Yeah.
Yeah.
Okay, enough
Yeah.
left weather. All right, so stock updates.
Exactly.
Stocks were flat Monday after key stock benchmarks reached record highs, and the investors awaited inflation data. Stocks are coming into the final week of February on a high note after the major indices, as Lee would say, achieved key milestones and registered winning weeks with help from Nvidia's blockbuster earnings. Blah, blah, blah. There's a rate of economic releases on deck, including January durable orders date on Tuesday, January wholesale inventories on Wednesday. The consumer spending and PCE numbers will come out on Thursday. So today, Tuesday, the Commerce Department Census Bureau said orders for durable goods tumbled 6.1% last month. Some were forecasting 4.5%. So I kind of butchered that. But thoughts? Stock market, where we're at, what's going on?
Do we want to go positive, negative?
Yeah, we'll go. Good comeback, cop.
World's going to end.
This is Nvidia's world, and we're all just living in it right now.
Yeah.
In a nutshell, earnings have been across the board strong. I mean,
yeah,
I don't think there's any way to sugarcoat that. I mean, there have been pockets of weakness here and there. But
earnings have been strong. Some guidance has come down.
Yeah, some guidance has come down. The AI world is smoking hot right now. I mean, there's no way to say anything else. The thing that was kind of surprising about Nvidia was they reported Thursday afternoon. Tuesday and Wednesday, they sold off pretty significantly because they had run up.
Oh, gosh. They've gone up so fast.
They reported Thursday afternoon or Wednesday afternoon?
I can't remember. Wednesday.
Anyway, they sold off the 2 days prior to that because they had run up 25, 30% just in 24.
Yeah.
But then they were up 15%.
And they were priced to perfection. And I think that was part of it. It's like, they just if they did not hit this crazy projection, they would sell off. And so the sell-off happened before that. And then they blew the numbers out of the water. And their guidance was even more optimistic. And so, we're, the numbers that are coming in from the Fed show that inflation is still there. Inflation has not really come down like they would like. What I told some folks last week is inflation is real still. I don't think it's going to be enough that causes the Fed to raise, but I think it is cementing their belief that they are not going to start lowering until, in my opinion, late summer into the fall. Now, we might still get 2 or 3 rate cuts in the back half of the year, but I think that to say we're going to get a rate cut before June, July, I just don't see it.
I agree with that. Beginning of the year, we're supposed to have 6 rate cuts potentially.
Yeah.
Now that's gone down to 3 to 4 potentially, which may or may not happen. But here's the problem. Here's pessimist side. The Fed said to us long ago that they were going to continue to raise rates until the inflation got down to 2%, even if it caused a recession. They are lying to us right now because technically they should be raising rates by another quarter point, and they are not going to. It's an election year. They've done enough, right, in their mind. They think the inflation is stalling and it is going to come down. I am paying attention to the inflation number, and I don't think it'll – I don't think it matters to the market run as much as we maybe give it credit to, but
that's fair.
I don't think we're going to get down to that 2% number anytime in a long while. But I also look at other data points like the M2 measure of money supply, which is coming out today, which nobody mentions and nobody cares about. The Fed doesn't talk about. It's important. And I think that's a number I'm paying attention to today. I'm also looking at the recent home price, the home sales, and then the home production. Those both went down. There are signs, and again, I say this all the time, spending is going to slow, and it has slowed based on multiple factors, whether that's credit card debt being at all-time highs, whether that's interest rates being high and housing still being high, and middle class and under are still having a hard time getting into the market. So I do think there's headwind there on the consumer side that will bleed into, potentially eventually the market, having a little fall from that. I also will say this: the AI stocks, they're booming, and we're in the world of Nvidia, like you said. we're in that world, and we're just living in it. But that doesn't make the entire market healthy. The AI stocks are great, and they've run up quite nicely, and you have those core 7 that have done so well. And I think there's a new one that's going to add to that. Maybe there's a core 8 now. But the point is, those stocks running this way will eventually run out of gas, and you need the other sides of the market to lift up. I also thought interesting, we're going to talk about Walmart in a second, but the 3-for-1 split happened, which is great news in my opinion for Walmart, right? I mean, it was the first time since 99. We're going to have easier access to Walmart for some of the ETFs and mutual funds that go after lower priced stocks, if you will. It gives access to more people, and that's the mindset of that. But I think there's some good stories out there that will widen the market out, hopefully.
And I think anyway, you're kind of silent, but I think that we've seen.
Yeah, I'm listening. There's so much wisdom in there.
I think that we've seen a broadening in the last half of the fourth quarter into this quarter. I mean, we're going to kind of touch on that here in a little bit when we talk about the Dow, but Walmart's was a good thing. I think another thing too is so many employees that work for Walmart. Not the corporate level, but the everyday worker at Walmart. When the stock price was up around 170, it was hard for them to be able to afford one share, like in the stock purchase program.
Right.
And so by splitting like they did, it allowed a lot of their rank and file employees possibly to
feel like they're accomplishing something.
Sure.
Yeah.
And speaking of Walmart, their bonuses. Typically in early March, I've heard it's a banner year, record year.
Yeah. That's awesome.
For Walmart
good
employees this year.
The Walmartians
good
out
for
there.
good for our area.
What are your thoughts?
Yeah.
Well, I was just looking at this. So I see both sides. I think it would be not wise to acknowledge that there are headwinds, right? There are headwinds out there. I think inflation. My thing on inflation is, I think we can get inflation under control by not necessarily having to. I think we can get to 2%, and I think we can get there by staying higher for longer, not necessarily by needing to increase more. Now, we'll see, right? Yeah. And we'll see how that plays out. But and that may mean we need to keep rates higher for much longer than most people want. But I do think I think that's possible, and I think it can happen within a realistic timeline that would be okay with the market would be okay with it. We've learned through this last rate cycle that like large cap technology stocks don't really care about interest rate hikes.
Right.
I mean,
right.
Like
Apparently,
if we've learned a lesson. It's like,
Yep.
well, they can absorb that.
Yep.
The cash they have on hand, the debt they've been able to lock in long term, going several years back. Like they've been able to absorb, 500% increase in rates,
Right.
and it not really impact them whatsoever. So how long does that remain true if rates stay this high? And I think all of that, I think the market's going to be fine, to be honest.
Yeah,
when I say that, I mean for this year, right?
Right.
We're going to have a pullback. I would almost guarantee you, we have a 10, 15% pullback. Most normal years do.
Yeah.
And we'll have another recession and another major correction at some point. I don't think it'll happen necessarily this year, but there's a lot going on out there. And to your point on market strength, you can always make a chart look however you want it to look, right? But if you just look, so I pulled up like SPY compared to the RSP. So it's the Invesco equal weight S&P 500 versus just the S&P 500. In the last 3 months, the S&P 500, value weighted is up just over 11%. The equal weight is up just over 10%. Okay. So
it's broadened out.
You've seen a little bit more strength in more companies than just the seventh versus compared to what you saw like the first 9 months of last year. Right. Where you looked at the equal weight versus the SPY, there was a huge divergence between those two.
Yeah.
The first 9 months of last year. And that's come back a little bit, which I think is healthy.
No, it's good.
There's more participants.
Actually, the M2 measure of money supply, I bring that up. Nobody cares about it. It actually has ticked back up. It actually is a positive sign. So, there are actually positive signs that the recession may be avoided, even from the pessimists here. Yeah. The one thing I can tell you about the higher interest rates, what does scare me about those rates is that we have not had that for how many years? 15 years?
Yeah.
And I don't think we've seen what the effects of that are yet. Small cap stocks that are highly leveraged, not the large cap stocks that do not need to borrow money, but small cap stocks that are borrowing money all the time for their research and development and so on. They're going to have a little bit harder time, right, with the debt. Not to mention the national debt that is at record highs with these higher rates. Those are the kind of but to the S&P 500 and the Dow, I guess I'm not as concerned. I was here about the small cap rally. When is the small cap rally going to happen? And is it going to ever participate in this great market? And I think interest rates are going to maybe stall that a little bit. We need rates to come down eventually to boost the small cap side. But all in all, I'm less pessimistic today than I was yesterday, and it's getting...
And we're seeing signs that we're not out of the woods yet. But again, the same thing, looking at the Russell 2000, same period last 3 months, it's actually outperformed.
Oh, no, it's come back.
So we've seen...
But look at the spike. So it did come back, roared back, and then it came back
sold
a little
off.
bit. Yeah. Sold off. But to your point, we've seen that
now, you don't
happen.
have to zoom... You zoom out a little further. It's like the Russell still looks horrible.
Right.
But if you just look at the last handful of months...
Which is a trend, which is a sign, and that's what you want to see.
That's what we've been. That's what we've been wanting to see.
I think you'll see that. I think the small cap can just go like wildfire if we do get interest rates, and I think the anticipation of rate cuts has helped the bond market. The idea of the bond market was going to rally, and the small cap stocks are going to rally. So I think there's part of me that wants there to be rate cuts, right? Just to spur on some of that other stuff. Yeah. But anyway. I'm not as pessimistic.
I really, to be honest, I don't know what we've said the last 15 minutes, but there was a lot of good commentary and conversation.
Hey, so can I just ask a question?
Yeah.
And one word answer. We don't have to elaborate on this podcast. Do you think the Fed's political?
Yes.
Yes.
Okay.
And there's that. So, all right. So the Dow. Let's talk about the Dow. So is the Dow a good metric anymore? Opinion from an article written by Alan Sloan from Yahoo Finance. The Dow is ancient and cumbersome compared to modern market metrics. Walmart recently split its stock 3-for-1, like we just mentioned, and because of this, the Dow replaced Walmart with Amazon and kicked Walgreens out completely, which we'll get into here in a second. Walgreens being booted from the Dow isn't exactly a surprise because its share price has fallen around 60%, while the Dow's risen about 60%. Had Walgreens kept pace with the other 29 components, the Dow would be about 400 points higher than it is. With the Dow near 40,000, it's easy to see that little impact even at an at pace Walgreens would have made. So opinion, Amazon being in the Dow keeps it relevant. So anyways, there's a lot of notes here, good stuff, but the long and short of it is, Walgreens got booted, Amazon's in, Walmart dropped way back because of. So let me kind of explain how the Dow works, and then we'll go from there. So the Dow, for those of you that don't know, the different indices. I'm going to use that from now on.
Okay.
Just so
Man, you sound so smart.
my SMU law degree friends say it's the correct way to say it. So you have the Dow Jones that's price weighted, right? So
Correct.
Literally whatever the price of the stock is dictates how much of the weighting it has in the Dow Jones. Then you have value weighted indices like the NASDAQ 100 and the S&P 500, which is looking at the company's overall market capitalization and what is the value of the stock. And so these aren't equally weighted, right? The Dow Jones is not the 30 companies equally weighted.
Correct.
The S&P 500 is not equally weighted 500 companies. You know, you've seen it a lot in the S&P 500. You know, the top 7, 8, 10 names makes up 30% of the index or something. So you're very heavily weighted toward those names. So going back to the Dow, it's price weighted. So when Walmart was trading for $170 a share, it was weighted at a much higher weighting than it is now trading at $60 a share.
Even though the market capitalization did not change.
Market capitalization didn't change at all. So it's something to be aware of when you're tracking these, indices that these things have a huge impact on how these indices are priced, right? And the value of them. There's a little bit more complexity to it than I think a lot of people realize.
And going back to the question, is the Dow a good metric? I don't use it very much anymore, partly because it's 30 companies.
This is coming from the guy who still quotes points, just so you know.
Right.
He says, hey, the S&P's up 30 points.
Okay. You know what? We're getting personal now. I'm about to walk off the podcast. No, I don't think it's ancient.
Right.
But I think you got to really keep it in context. I mean, because it's not a good representation of the total market right now. The S&P 500 is better, but it is not perfect. But if you want to kind of get a good idea of what the market is doing, you got to look really more at the S&P 500 than anything else.
Most things are compared to the S&P 500, right? ETFs, mutual funds, anything that you see is compared. How did it do versus the S&P? But if you watch any business channel, they talk about the Dow. The Dow is the biggest number that is shown on the screen. They have the S&P, they have the NASDAQ. They have gold, they have oil, but the Dow
is like the Berkshire Hathaway of indices, right? And it's well known.
Look at you go with indices,
and it's not even.
I'm running with it.
And it's not even the 30 largest companies.
No,
I know exactly.
So here's the constituents. So you have United Health, the largest weighting at almost 9%.
Yeah.
Of the index. Microsoft is number 2. Goldman Sachs, Home Depot, Caterpillar, McDonald's, Salesforce, Amgen, Visa, Travelers, and those all have a 4.75% weighting or more. So if you add those up, I don't know, I'm not smart enough to do quick math, but that's like 40-50% plus of the index in the top 10 names.
Yeah.
Right?
And you know what? And there's some people out there that wouldn't know maybe what one or two of those companies even does.
Exactly.
Yeah.
Exactly.
So I think in my opinion, I think you said it is absolutely relevant, but is it the best? The S&P 500 is probably, when you're looking at the United States stock market and what's the best representation, the S&P 500 does a better job of that, right? It has more constituents. It's value weighted. There's pros and cons to that.
Correct. But again, I mean, it's not perfect, but it does get you a little better idea of, and that's why through the middle part of last year, maybe even through the first 9 months of last year, the Dow was either flat or negative, and the S&P 500 was up, double digits.
And there's pros and cons to, for example, someone, if you want to own Walmart, now's a great time to own Walmart, in my opinion, right? Stock split. Sometimes there's some strength that comes out of that.
Yeah.
People are used to Walmart trading at $100 a share or above. If it's trading at 55, I can't explain why, but there's something to psychology of buyers are going to be buyers if Walmart's trading at $55 a share, right? And so, but if you're just tracking the Dow, which I don't really know anybody who is, but if you're just buying is there a Dow index fund?
Yeah, I think so.
I'm sure there is. They're just not very high.
I never use them.
You would get less Walmart exposure, because of what just happened, even though you may not want less Walmart exposure, right? So those are the kinds of things you just need to be aware of. And with the S&P or the NASDAQ, some of the best companies, Tesla is a perfect example, right? They had seen a ton of growth. I'm not recommending Tesla, but they'd seen a ton of growth. And if you were a buyer of Tesla going back years ago, you had to wait a long time if you were going to wait for them to get added to the S&P 500, right? You missed out on a lot waiting for that to happen. So anyways, all of that said, just be aware of how these indices work, how they're, calculated and formulated, who the constituents are. And know that if you're just tracking one of them, you're probably very overweight 10 names.
Sure, tech.
Well, with the S&P.
With the S&P.
Yeah.
But, that's why over the last several months, we've kind of brought into the discussion the S&P equal weighted.
Sure.
The S&P 500 equal weighted index, because that is just it. All 500 names are the same percentage in the index.
Right.
Gives you a little bit better idea. But yes, I mean, the indices are governed by some pretty heavy names. Big names.
Yeah.
So.
Yeah.
Any thoughts?
No, we've beaten that one. We did a good job of that.
Okay. Moving on. So last topic, getting started young. So Sophia started investing when she was 14 years old thanks to acquiring an income with social media. Her parents helped her, but she was also money savvy. When it comes to her strategy and her biggest approach to managing risk, the young investor suggested investing in index funds, which we just hammered. I'm just kidding. That kind of helps diversify the risk of investing more than the kind of if you were just to invest in individual stocks. I think that it takes patience and perseverance to just know that you're taking risks, but that it's worth it. So there's a great example.
14 years old.
She's 17 now. She's 17 now. She bought her own Tesla with money that she made.
Wow.
Well, I don't know if she is all from that, but my point is she invested in Tesla, Apple, and Amazon and index funds. Pretty cool story.
I've met with so many young people, and they want to educate themselves, which is great. And I think people should read and educate themselves as much as possible. But sometimes they get into the weeds of like, should we be buying this and it's like at a certain age when you're young, you just need to keep it as simple as possible and don't overanalyze it, don't overthink it. Just build the right habits, automate everything you can, and just keep the investing side of it as simple as possible. So go buy SPY, go buy QQQ. And just do that, and learn the ups and downs of the market over those first few years before you really start trying to get into the weeds of the details of investing. Like there's a lot that you just have to learn by doing.
And dollar cost average is another. Like if you're going to do something and you can afford $100 a month, buy an index, put $100 a month, like in that example, because the markets go up and down. They go down, it actually is in your favor because you're buying more shares. And if you could teach that to young people over time, 30 years from now, they're going to have many downs and many ups.
One of the best things you could learn in your early years is what is your actual risk tolerance. Because, so you fill out a risk profile questionnaire, you do something. That's very different than how do you act when your portfolio is cut in half. Right. Most people, those two things are not directly aligned, right? What they say they're comfortable with.
You're right.
And then when that actually happens, how are they actually reacting? And so if you can learn that about yourself in those early years, Sophia's going to probably be worth more than any of us combined. No doubt. Because
we'll be going to her for advice in 10 years. Yeah. But her point, patience and perseverance are the two best words that you can put to an investor. Patience and perseverance.
Yeah.
Thoughts?
Yeah. No. I mean, it's easy to be patient and perseverant when you're 14.
And when the stock market keeps going up.
Yeah. When things are great.
Yeah. So,
all right.
Good for her. Good for her parents. She
absolutely. So, want to end with a comment that we got on the last one, which is this perfect timing, kind of rolling off what we just talked about. So, frequently told young workers who are just out of college, jump into the 401k plan and place as much of a contribution as you can afford, and try to commit to the amount of your company. The company will match. It's free money. So that's from D. Nelson. Appreciate the comment. And absolutely, like we were just talking about, start early. As soon as you get that first job, you get a 3%, 6% match, whatever it is. Jump in, start doing it. If you do it from day one, you'll never know you're missing the money.
Correct.
You never had it to begin with. And then try to just, as you get pay increases and things, just incrementally.
Hey, like Walmart 401k, you can, and most of 401ks now today, you can start, like let's say it's 6% to get 6% as it is in Walmart, right? So you start at 6%. Put on there, you can click a little button that says each year I'm going to increase my contribution by 1%.
Right.
And it will do that for you on every anniversary day. You won't even know it's there. And by the time you'll be max funding it within 5 years, right? Because your percent will continue to go up. You won't feel it because you're getting a pay raise, and that little tiny percent added to you will not feel it. And then over time, and then one of the things was about when to pay off debt. But I do think you get the free money in the 401k for sure, and increase it like that, and then you pay off focus on debt, and then you can increase it to max funding as soon as you can.
Yeah. All right. Well, good conversation. As always, we appreciate you guys listening. Give us a like, subscribe, share us on your social media, and keep your eye out for, like I said, future guests that we've got coming up in the coming weeks. We're excited about that. So we'll see you guys next week.